So what I'm telling you is this: you have to look at your chart and try to mark the highest point you see in your chart and the lowest point you see in your chart. This is the lowest point you have in our chart, and this is the highest point you have in our chart, as you can see. So from this structure, you look where you have a recent break of structure from here all the way here. This is your recent break of structure. This is your recent break of structure. This is your recent break of structure, meaning we are bullish on Euro USD, and our range, our trading range now is this one. Our trading range is this one. So the way market moves, market is always seeking what? Market is always seeking liquidity. When the market is done taking liquidity, basically, when we use ICT method, we simply mark this level as a buy stop, right? Or external liquidity, whatever you call it, right? So the liquidity that's sitting outside of your range, on your left side, for example, if you are bullish, the outside liquidity, and we have internal liquidity sitting here, market will be looking for. So this is going to be your major liquidity, your external liquidity, market will be looking for buy stops, right? And then after grabbing this liquidity, market will be pushing down to do what? To look for some sell stops sitting all the way here. So if I have to show you something to remember, here, let me show you something here. So you have principles that will govern your strategy. Principles that will govern your strategy, right? So market structure, mark order flow. This is what we are doing. Try to mark order flow every time you open your chart. First of all, mark your order flow. Try to know the range, right? So after order flow, mark inefficiency, mark gaps, mark liquidity, mark premium discount of your range. These are the principles you have to follow. Then recognize what? Mode 1 and mode 2 setup. Remember the concept of price anytime theory to apply power of free, which we discussed today. And then remember market maker buy and sell models, right? So here, after marking our order flow, you have got what? You have got another task of what? Of marking what? Of marking our inefficiency, price inefficiency. Remember, do not trade any pair without doing this, because this is what moves the market. This is what market is looking for when market is moving. Market will be looking for this price inefficiency we have here. Market will be looking for price inefficiency you have here. So this is your candles. We're going to have another candle here. These are your candles, right? Do not trade any pair. You are going to see the power of this. Do not trade any pair without marking your inefficiency. You see this candle opens here, for example. Then, for example, here you have what? You have your candlestick high and low. Candlestick high and low. When, for example, you have your candlestick high and low like this. So you have to compare three candles, no more. Only three candles. When you are trying to identify this concept, compare three candles. Compare three candles. So what is inefficiency? So when you have your chart, you have your candlestick moving, and then you see you have your first candle is here. This is your first candle. Candle number one. Then you have candle number two. Then you have candle number three, right here. So here you have to look if the high of your first candle and the low of your third candle overlap. If they don't overlap, there is price inefficiency there. So the algo will be coming back to look for this zone. And this is where you'll be finding what? You'll be finding your POY's point of interest. And this is also where you'll be finding what? Where you'll be finding liquidity. So when we talk about, for example, doji manipulation, so any doji candle, for example, sitting here is likely going to be manipulated because price is coming back to feel inefficiency. So any candle sitting here is likely to be our bullish order block, your sponsored candle. Markets will use to go higher. So you have to remember that. Make sure you mark this zone. Make sure you mark this zone. And then you can even add a beautiful color here. Just to help you remember this zone. Help you remember this zone. As the zone of what? As the zone of price inefficiency. So price is likely to come back. For example, if you are trading, if you are going to trade daily candle, for example, power of three, right? The next candle may open here and it goes down to trade the lower. For example, this is Monday. So this is in the morning, for example, daily candle, right? During the London session, for example. And you see the candle is leaving to close above. To close above. The candle is pushing higher to close above. But you have seen that your candle has traded all the way down here. So your task is to enter on this low. It's what you are looking for. Depending on this low, targeting what? External liquidity, this candle, buy stops. So this is gonna be a sell stop. It's gonna be a buy stop. Or sell side liquidity, buy side liquidity. Is what I say. Your task is to look for entry on this level using what? Using market maker buy model. Number 4. So when we say identify your range and identify your price inefficiency and the gaps. You know, when we say gap is when market opens, for example, above the close price. Basically, a candle must open where another one closed. So mark your gap, then mark your liquidity premium discount of your range. When you say premium discount of your range, you simply use your feed Fibonacci from the low all the way to the high. And premium discount. So you have to see market must trade at least 50% or below of your range in order to be bought, to be considered a high probable high probable market for buy, right? So you understand. So after doing this, what we have to do is to mark what? Is to mark your price efficiency. So for example, here, if you look at this chart, this is Euro USD, 12-month time frame. So from here, you see, remember, you compare two candles. For example, if you start from the bottom, you have this candle, we have this bearish candle, we have this bullish candle, and this bullish candle. So the high of this bearish candle, and the low of this bullish candle did not overlap. As you can see, you have a price inefficiency between these two, between this candle and this candle. From the first candle to the third candle, there is price inefficiency. And then from this candle again, from this candle to this one, to this one, you see here, this is free candle. One, this bullish candle, second bullish candle, third bullish candle. Also, between these three candles, you can identify another price inefficiency. You mark from the high of this candle, you have a small high, as you can see, there is a small high here. A small high. And then all the way here to this third candle, we had what? We had assumed that this candle is not here as of now. So we have what? We have price inefficiency. So you can mark this area as your area of what? As your area of price inefficiency. Price inefficiency, as you can see here. Before this bearish candle comes in, this was our price inefficiency. Again, here, in this candle, from this low, all the way here, you have another price inefficiency. Right here. Your chart must look like this regardless of any time frame. Don't ask me which time frame I want to use. If you are M1 time frame, 1 minute, 15 minutes, 5 minutes, depending on the range you are going to trade. Remember, every time frame is going to create a range. Depending on the range you are going to trade, make sure you mark this price inefficiency, because this is what the market is looking for. This is what the algorithm is going to look for. Right? So if you study the nature of this movement as Euro USD was pushing down, try to see how it was dropping, and then it feels the first inefficiency to the peak, right? You see that? After feeling that, it starts creating what? It starts creating a short time high all the way here. So where is this high going? This high is going to look for what? It's going to look for ways to fill another price inefficiency we have here. If you spend a little time on your chart trying to identify this, you'll be surprised. This is how the market moves, right? This is how the market moves. But you have to start from a range. This is why from the beginning, we always say range, because range is the only thing you need to be able to quickly spot the direction of the market, right? Try to see again after feeling, for example, 50% of it, especially when we are bearish, market is likely to feel maybe 50% or a small portion of it, and then start making a reversal, right? And then you see it start dropping down. So if you start dropping down, What do you think market is looking for? Market is going to fear the next inefficiency you have here. Let's see it yourself. Market is fearing price inefficiency and then it is rejecting. So for now, if you were to tell the direction of the market, if you were to tell the direction of the market, where is it going? Where is it going? First of all, remember, fearing this inefficiency doesn't mean Euro USD is going to come back here. No. We are bullish, we understand. We are bullish, we are thinking how Euro USD, sorry, we are thinking how Euro USD will go higher to take the high. As the rule that govern the range, after creating a pullback, we need to see price going higher in this area. But what if Euro USD want to break the structure below? Because not every time market is going to create what? An uptrend, right? So you have to think all of those. You have to have that mindset. So all you have to do is to recognize what? Recognize your internal structure market is using. Internal structure. The structure market is using when creating this downtrend. And then you are going to identify, remember, internal structure is bearish. So you have to mark your internal structure range. Your internal structure range. This is a bullish range, but we may have what? We may have internal structure going like this. So this will be a breakout structure. Here, it's going to be a pullback. Market goes down, breaks the structure. It's going to be a pullback. Market goes down, breaks the structure. It's going to create a pullback. So when it is here, it can easily continue to go down even further and trade on this rejection block, for example. And trade on this rejection block before it goes higher. So you have no permission to say, okay, you are done feeling this level, it's time to go higher. No. You will confirm that it is going to go higher when it is done what? When it breaks a structure after grabbing what? After grabbing this liquidity, say stop sitting here. It's liquidity here. It was broken, of course, as you can see. So maybe I can change to higher time frame a bit. Sorry, higher time frame like 6 months, that you can see what I mean. So what I'm telling you is this. Try to see how Euro USD created a low, created a high, created a low, created a high, created a low right here, a high, a low. From here, you know what? You have a bearish range. Remember, you still have also on another time frame, you still have another zone that was not filled. As you can see here, you have another price inefficiency, right? So you are limited to the current range you have, which is this one. Which is this one. You are limited here. This is your range. Since this is your range, now you're going to think what? You are going to think how market is going to create a pullback. So if it's going to create a pullback, what is your task again? From this downtrend, you're going to mark again your price inefficiency. The first one is here. You see, from this first candle, second candle, third candle, we have what? We have a price inefficiency. We want to see market filling this zone. And again, from this candle, first candle, second candle to this bullish candle, we have a price inefficiency. We want to see market trading there. We want to see market trading there. can see. It can trade all the way higher or 50% of it and then create a reversal, right? But every time you identify your range, don't forget the concept of what? Fibonacci retracement. As you can see, from the high all the way to the low, market did not create what? Did not touch 50% of it. Meaning on Euro USD, we are likely to even trade higher, at least to hit 50%, just to reach a premium zone for a possible sell, or a possible sell opportunity. You understand? You understand this, for a possible sell opportunity. For a possible sell opportunity. For a possible sell opportunity. Someone asking, yes, you understand, right? So we go to, let's go, for example, to monthly time frame. You are done seeing what the high time frame is telling us. Right? You are done seeing what? You are done seeing what the higher time frame is telling us. Someone asking, this supposed to be what? This supposed to be your primary liquidity. The market is trading back here. So here, as you can see, market was dropping down. We have a beautiful structure forming here. A beautiful structure forming here. This structure was broken. The structure was broken. So these are the higher time frame imbalances. They were filled. Now we can do what? We can when you're asking Fibonacci retracement, we'll talk about that. So here I have what? I have my imbalance again. Why am I marking this imbalance? Because if Euro USD is going down, start dropping, I will be expecting price to trade within this area. Again, look at this candle, this monthly candle, this one. Look at how it went all the way down to fill imbalance here, to overlap the first candle. You see, this is what we want to see in the marketplace. This is what we want to see. So power free means open price. Power free, the candle will open. The candle, power free, the candle will open. The open price. It goes down to look for something. After that, it goes higher to target something, and then it crosses somewhere. So we want to buy here. So if this candle opens here, you see it went down, and then to look for what? To look for something which is what? Imbalance. Then goes higher, then it closes. Just you have to think. You have to think like that. So this is our monthly candle. It has opened here. We are still moving. It can easily drop all the way down here to look something. For example, we have on a daily, for example, and then it goes higher to fill something here with a beautiful move. This is the beginning of the month. That we're in the first week. Right? This candle can do anything, can go down and then it goes higher. You to understand. Then here, you can go to weekly time frame. And go to weekly time frame and try to see what the market is doing. So, then check where on the monthly. Okay, on the monthly we have another imbalance here on the monthly time frame. We have another imbalance on the monthly time frame here between these two candles. This one was a filled, so we have this one left on the monthly time frame. Now, on weekly time frame. On weekly time frame, we have a gap. We have what? We have a gap. This is what we call a gap. When the open price, you see this candle closed here. Now that candle is supposed, you see this candle opened here, closed here. Another candle is supposed to open right here on the same line, but you see it opened below. Look at this area. So this gap will become a future target. It will become what? It will become a future target. So market can feel this imbalance and then trade within this area and post B, create a certain pullback to look for something. So you have to understand. You have to understand. So what we mean is this. For example, here, if you are going to trade a weekly candle, for example, if you want to trade this bullish candle you have here, you have to know you have a gap below. You see where this candle closed? This bullish candle closed here. Another candle opens here with a clear gap. Market is likely to come back again in those zones before it makes a rally. So by knowing this, and you have an idea of power free and trading sessions, you know high probability that market is likely to go higher. But remember, with this, what I want from you is to try to catch a daily candle and go out of the market. A daily candle and go out of the market. You do not have to hold for 2 weeks. No. A daily candle and go out. Daily candle and go out. That's it. So, this week we are pushing higher. We are pushing higher. On a monthly time frame, this is the first monthly open. This is the second open. When you put a vertical line in a monthly candle, so you are going to see what? You are going to see some structure right here. So as you can see, look at here. This is the monthly open. The monthly open is here. You see all of this manipulation that took place before price goes higher. The same, this candle, this monthly candle can do anything, right? And you don't know which one it is going to do, right? It can do anything. For example, comes back all the way down, maybe trading lower on this level, and then it goes higher. Why this level? Because I have, for example, I have price inefficiency here. I have gap. This is the gap. This is the gap. Market can trade on this area to create the low of the April. Yeah, we are on April 26, no, 8, right? To create the low and then goes higher. But you do not have to predict this until the market tells you that. You know this can happen, power of free. This is the open price. It can go down, then it goes higher. Right? So you do not have to predict the movement. Your job is to mark the structure market is using. To mark the structure market is using and know your range, only a range that will tell you where market is going. So, for example, after this manipulation, market went higher. We are starting our range right here. This is a range. Market creates a shallow pullback on this area. Try to ignore this a little bit. I'm going to delete it. Before you talk about the sessions that will be done, we're going to study very soon, you have to start from structure. So this is a break or structure. Every time market takes a liquidity, expect a pullback, right? This is the buy stop. Boom, pullback. But this push to downside doesn't mean that market is going higher. So the market is going down, all the way down here. Remember, internal structure continuation. Last area of BOS before a main break or structure. Don't forget those concepts. As you can see, we have a retractable break or structure here because this is a pullback. When you have a high and a low here between the bullish candles, you have to know that there is a pullback. So we have a price inefficiency. Market is coming to fear this inefficiency and then goes higher. Remember one advice: do not force the market. If it is creating a higher high, understand that the market is creating a higher high until it proves you otherwise. Do not try to sell a bullish market. Right? So you see, market went higher on this area. So this is from here all the way down. This is a pullback. This is a bullish, a break of your ranges here. Everything you see is internal structure. Everything you see here. But within this internal structure, you are working on what? You are working on the daily candles, right? You are working on the daily candles. Try to see. We have imbalance here. You have imbalance here. You have imbalance here. Market comes back to fill it, trade lower, and then start going higher. Start going higher, right? So everything you see is internal structure. Let's say, for example, if Euro USD trades higher, comes down, trades higher, comes down, trades higher, this is internal structure that is being formed within this range. We are still having this range. Market can easily reach this area, then create a deep pullback into this range, and then it continues to go higher. You have to differentiate a structure and internal structure and internal structure continuation. This is very, very powerful. Train your eyes to see that. If I'm trading Euro USD, I know everything I see here, this is a range structure of this BOS, because after this broker structure, we didn't see a deep pullback here. Market can easily drop with a single candle and it comes back here. So you have to know that, because this is a range. Market did not come back, trade within that range. Right? We have a 3 minutes left. I'll be sending a link again because we have so much stuff we need to talk about. Right? So you see, we are starting from higher time frame. We are starting from higher time frame. Market is done trading on this area. Remember, this is the weekly open. This is the weekly candle. Remember, look at this. This is a weekly candle, right? This is a weekly candle. So next week, we are going to have another candle here, opening here. So on Monday. So according to you, is this candle going to trade as a bearish candle or is going to trade as a bullish candle? Right? So you have to understand that. So the high probability is that it's likely to come back down to create a low, and then it goes higher to create a high, and then it closes. You have to think powerfully like that. Right? You have to think powerfully like that. It's going to trade down and then trade higher. We have to start thinking like that because we are bullish. So if it closes as a bearish candle, we will study the scenario, and then we'll be preparing our playground for the next week that will follow this coming one. Right? The following week. So if market, you know you have lots of stuff here, market wants to achieve, to move, for example, this area. So you have to do what? You have to think how the next candle is going to move. Is going to move. Just the whole week here, you have to study the open price and try to think if it's going to go down, what is it likely to look for, right? So you have to remember all of these gaps you have here. It can trade back into it, right? Remember, this is formed within your range. Our range starts from the bottom to the top. If I go back to daily time frame, you see, our range starts from the bottom all the way to the top. We have what? We have a gap here on our time frame. You can easily create a low here with a quick move, and then it goes higher. You know that can happen. But before that is going to happen, what do you have here? Just drop to lower time frame again to see what is likely to happen. And again, avoid trading on a Monday. Trade on Tuesday, Wednesday, and Thursday. Monday and Friday, ignore. Because Monday is going to give you a full picture of how the week is likely to move. We have 1 minute left. I will be sending a link again. And then you will do what? You will join, because I say it's going to be an offer. But you have to think what is likely to happen. There were so many trades going on here.